Today we're diving into 5 proven indicators for short-term trading. Selected and ranked using real historical data, tested by quantifiedstrategies.com. These aren't just theory. They're backed by decades of S&P 500 performance. Before we jump in, make sure to like and subscribe if you want more data-driven trading content. Let's get into it. Here are 5 technical indicators every swing trader should have in their toolbox: the Relative Strength Index, Internal Bar Strength, IBS, Stochastics, Bollinger Bands, focusing on the lower band for entry, and finally, Williams Percent R. We'll show you equity curves and stats for all of them, so stay tuned. So, which of these comes out on top? Interestingly, it's not the one you might expect. Williams Percent R consistently delivered strong, steady results, especially when markets got volatile. It kept drawdowns low across multiple parameter variations, and that kind of reliability matters when your own capital is at risk. Here's how we ranked them. We ran backtests on 5 oscillators using S&P 500 data from 1993 onward. Included 0.03% slippage and commission costs, and sorted them by risk-adjusted returns. What does that mean in practice? Risk-adjusted return compares how much a system gains relative to how deep its worst drawdown goes. 2 systems might return 15% a year, but the one with smoother equity curves and smaller dips is the one that'll help you stick with it. That's especially key in swing trading, where emotional discipline is everything. Let's start with the Relative Strength Index. This version buys when the 2-day RSI falls below 10 and sells when it climbs above 60. But since 2015, results have been rough. It took a 30% hit during the 2020 COVID crash. And that kind of drawdown usually causes traders to pull the plug. Next, Internal Bar Strength, or IBS. This one gauges where the daily close lands relative to the high and low. An IBS of 0 means the close is at the day's low. 1 means it's at the high. We used a 2-day moving average of IBS, entries below 0.3, and exits at 0.8. The performance was solid, but the drawdown hit 35% during the 2008 crisis. Not ideal. Now let's look at stochastics. We used a very short 2-day look back with buy-sell levels at 10 and 70. Trade frequency was low, but drawdowns were impressively shallow, just 15%. That kind of stability is rare. Next up, Bollinger Bands. Since stocks tend to revert to the mean, this setup buys when the price dips below the lower band and sells at the upper band. We use an 8-day look back and adjusted the bands to 1 and 1.8 standard deviations. The long-term results were decent, but drawdowns in 2003 and 2009 reached 45%. The reason? This strategy keeps you in the market more often, so exposure is higher, a bit like buy and hold. Finally, we have Williams Percent R, our top pick. This indicator is similar to stochastics and works on the principle of identifying overbought and oversold conditions. We used a 10-day period, entering at -90 and exiting at -80. The numbers are hard to beat. Maximum drawdown, 18%. Average gain per trade, 0.5%. Best year, plus 24%, 2002. Worst year, minus 3.4%, 2018. In terms of risk-adjusted return, Williams Percent R is the winner. So there you have it. 5 proven indicators for short-term trading, each tested and ranked by performance. Try them out and see what fits your style. If you found this helpful, don't forget to like, subscribe, and tap the bell so you won't miss future videos. Thanks for watching!